Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. In today's episode, we are once again joined by Director of Quantitative Strategy, Denise Chisholm, to discuss sector trends, market movements, and crucial topics in the investing industry. With the recent CPI number out, Denise believes a rate cut is likely. The latest data shows shelter costs aligning with 2021's level, signaling that inflation pressures are easing. Denise cautions that the rapid normalization occurring may feel like a recession given its contrast with past decades' conditions. She emphasizes that investors need to stay open-minded and consider diverse factors influencing the economy beyond recent historical norms. She notes that small caps have begun broadening out after a lagging effect over the past 6 months, as well as stressing the importance of considering earnings growth as it drives the market. Denise closes off by giving her thoughts on Canada's labor demand, diving into sectors sensitive to interest rates, and identifies attractive opportunities within small cap stocks amid potential market shifts. This podcast was recorded on July 11th, 2024.
Hi Denise, how are you?
Hi Pamela, I'm well. It's great to be here.
Yeah, it's great to have a chance to speak with you about the labor market, about what it means. We'll certainly ask everyone to send their questions in throughout this show. I do want to just start with the CPI number though, because we just got it out. Yes. And it had some very interesting pieces that seemed to line up for a lot of people thinking there should be a cut.
Yes, and I think that's probably the right conclusion from it. I think for the first time, really in 22 months, I think shelter finally cracked to a level that is consistent with something we saw in 2021. So that was really, if you've listened to me before, I think that when you looked at core inflation, which is ex food and energy, and you looked at that ex shelter, you really didn't have an inflation problem on a year-on-year basis. Even the CPI, which runs a little bit more elevated than the PCE deflator, which is the Federal Reserve's preferred definition of inflation. When you look at that, you were at a run rate, on a year-on-year basis of below 2%, excluding shelter. So really, shelter was the final component that I think would give the Federal Reserve the increased confidence that we are headed towards 2% eventually. So that crack in the shelter that we saw just this print, I think was a pretty definitive one with, again, no real resurgence in the rest of the CPI. So I think the conclusion is that we don't really have an inflation problem. And if we don't have an inflation problem, we likely do not have a Federal Reserve restrictive monetary policy problem either.
So just because it's such fun to worry, are we going in the other direction too quickly? I mean, is it actually dropping too quickly? There are those bears perhaps asking that question. Like, what does it mean for the economy if we're actually dropping out of this inflationary environment maybe too quickly?
Yeah, no, it's a great question because there's a lot of data that shows that when the Fed cuts, it should give you pause as an investor. If you look over just the last 3 cycles, when the Fed has been cutting, the stock market has been plummeting because the economy is headed towards a recession. I think that whole signal is a lot less clear when you look at all of history. 50% of the time, historically, the Fed is cutting because we are approaching recession, and about 50% of the time, historically, they're recalibrating monetary policy because inflation has come in lower than expectations. So the question is that people are struggling with right now is that, can we look at the labor market and worry, to your point, that this is really the signal of why maybe inflation is decelerating at quite a clip? And we're getting these mixed signals. So we've seen initial claims start to rise, and we've seen the unemployment rate rise at a very quick clip now. It's actually at a top quartile move over the last 14 months. And there is something, if investors are paying attention to, called the Sahm rule, which was, sort of established by Claudia Sahm. You can actually follow her on Substack. She writes about her own rule and whether or not it actually triggered her rule. But I think on a rolling 3-month basis, there's a concern that once you sort of breach this 0.5% threshold, that once you are in this unemployment rate rising, the unemployment rate tends to keep on rising. And it rises more like an elevator and comes down like a feather. So there is this increasing sort of skew towards the downside risks that Chair Powell was very notably pointing out over the last, let's call it, couple of press conferences or a couple of statements that he's given. So yes, people are very concerned in the market. So the interesting part to me is that when you dig into the data, the rise in the unemployment rate really only signals, especially when payrolls are still growing, recessionary risk about half the time. So the unemployment rate can rise through a demand shock, right, meaning people losing their job, but that's really not the situation we're seeing. The unemployment rate can also rise through a supply shock. When you get that labor force growth, and when you get, to your point, that increase in the participation rate. So that is why we are seeing these mixed signals, why you can have a rise in the unemployment rate, but wait a minute, payrolls are still offering positive growth. And historically speaking, when you look at those situations in history, it's actually been a pretty good spot for the stock market. It's delivered above average returns, even though it's not particularly typical. We saw it in the mid-60s, and we saw it in the mid-90s. So it has happened before. So it doesn't necessarily have to be a negative signal.
Because there are more people looking for jobs, essentially, which means there are less people that are maybe still, if there was still the story of COVID savings going on, like this is sort of the reassurance that people are back in the market for whatever reasons those are. When does that line up with what happened in, say, did you say the 70s? The 60s? The 60s and the 90s, or the 70s and the 90s. But was there some sort of supply that was similar to that? Had people coming back into the market?
That's exactly right. So you did see that. So labor force growth or labor force participation. And I'm talking specifically about prime age participation, so 25 to 54. And even when you look at the entirety of the labor force is actually now growing on a year-on-year basis, which is something that we didn't really see post the financial crisis, where people were exiting the labor force. I think that there's still this base case by a lot of people, like, who else can come back? We're in permanent decline. And I think once you see, which we did see in the 60s and the 90s, when you have nominal wage growth, is that just like when you have high prices with other commodities, say, it calls supply. So when you have now nominal wage growth that is in excess of 3.5%, and finally, for the first time, real wage growth that is actually positive, well, now people are more interested at maybe finding a job. And that is a very different situation and a very unique situation that doesn't necessarily have to give you a very bearish signal. So again, we might be thinking about a lot of these increases that are really just renormalizations, thinking them as recessionary risks, which I think history can sort of show you, well, wait a minute, there's actually more behind the scenes than just this one indicator.
It's so fascinating, as you say, renormalization, because that also takes us back to sort of the interest rate environment that we were in for 20 years. And so it might, just to your point, it might feel like a recession because it's just so different. Is that part of it? Yeah.
Yes, I think that's right. Well, look, we have forgotten what mid-cycle slowdowns look like because we effectively didn't have one for the last let's call it the last 15, 20 years. And in fact, the last 3 recessions have basically been a sudden stop, which is also very atypical in history. So as much as we want to gravitate back towards our last 10 to 15 years, I think the last 10 to 15 years was more the exception than the historical rule. So we might be in an environment where we have to be much more open-minded as investors and consider other things going on and the nuances behind the data that we want to use as signal.
So, I mean, there was a big discussion that, even through the pandemic, we didn't have the right models to measure essentially what was happening because it was just so weird and different. Is that also happening now? Have we been dependent on models that we used for a very low interest rate environment, or is there some shifting of the guard there?
Probably. And look, I think that we sometimes, especially as investors, give the Federal Reserve too much credit of being able to control the economy, when in fact that many times they are just reacting to the economy. And I say that because the higher interest rates are, the more likely they are historically to predict positive forward future growth, right? So to the extent that there was this calibration where the Federal Reserve could actually raise interest rates to a level and then lower them to generate a steady state of growth, I actually think that when you look back in history, that's pretty hard to do. They're usually just following a trend. They followed the trend of inflation higher, and now they are likely to follow the trend of inflation lower. And recessions, while we want to try and model them, are actually quite rare occurrences that are very difficult to model because they come more often from shocks that are, in some ways, can't be modeled at all.
No, you can't. You can't be modeled at all. Okay, so let's say that, so the why investors care. You mentioned it earlier. Investors, often will enjoy quite a good period out of this, so that's why they would care. If we're marching towards, it looks like some cuts, we come back to some of the sectors that are interest rate sensitive, I'm assuming. How is your outlook for that, and kind of where does it begin depending on where the cut comes?
Yeah, I think so. I mean, the one unique part of this market, or I should say this entire stretch, that it is what is different this time is the dominance of technology, where technology has really been the only sector that beat the market. It's not the only sector that's up on an absolute perspective. So this is nothing like we saw in the bubble where you'd say, hey, there's some red flags waving. Lots of stocks are participating in terms of lots of stocks going up, but some of the stock market, specifically on an equal weighted basis, specifically on down the cap spectrum, and specifically interest rate sensitives, have been left behind in this rally and have deeply lagged the rest of the indices. The question is, if we are, to your point, marching towards a cut, does this improve the risk reward? And I think that you only have to look back, even over the last 10 years in history to find that lowering interest rates has been a catalyst for those interest rate sensitives like financials, like real estate, like small and mid caps. So what has been interesting to me is that usually it's not necessarily a whites of its eyes trade, meaning you don't normally have to wait until the Federal Reserve cuts interest rates to have some relative outperformance. That obviously has not been the case this time, but that doesn't mean that that risk reward has changed. We still see really strong positive relative valuation that has historically been predictive in the past, meaning that financials are cheap relative to history, real estate is cheap relative to history, small and mid caps are cheap relative to history. You have wide valuation dispersion, which is a way to think about there's a lot of fear in those industries. So if you're worried that banks are going to be too regulated, that real estate is in secular decline, or you're worried that interest rates are going to, sort of be the death knell behind small and mid cap stocks, I will tell you that the rest of the market is worried in the indicators that I look at, which all of a sudden creates your risk reward of potential upside risk. And so to the extent that we get this catalyst, we may finally start to see the broadening out of the market that a lot of people have been waiting for the better part of the last 6 months.
And within that broadening out, we're really talking about, and I'm going to oversimplify it and then you'll correct me, but we've seen a broadening out actually. There has been a broadening out. We're talking about small caps, basically.
Yes.
And things that do really well with an interest rate cut. And that's what we haven't seen yet. Although actually we're kind of seeing movement today.
We are seeing movement today, but it's been after, it's sort of a lagging effect over the course of the last 6 months. So yes, I think that the risk reward has been improving as we've been marching towards that rate cut, which again creates as much upside risk that I see relative to the downside risk. Especially true, when you just step back and say, what environment are we in? We're talking about interest rates a lot, but we also need to juxtapose that with earnings growth, because that's the real driver behind A, the market, and B, sometimes small caps. So you don't historically want to own small caps if earnings growth is decelerating, even if the Federal Reserve is cutting. But the risk reward does improve dramatically relative to any baseline when earnings growth is growing and accelerating, which is the situation we're in. So check that box. And you have a situation where the Federal Reserve is cutting. That actually deeply improves your risk reward down the cap spectrum, which is what I expect us to see as we go through the latter half of this year and into next year.
And the cap spectrum, how much further down can we go? So, at the bottom sometimes are companies that maybe you don't want to invest in because their balance sheets are not what you want. And that happens sometimes with lower cap stocks. But within small caps, I guess just take us through a little bit what might be particularly attractive.
Yeah, so I think that within small caps, I think from a sector perspective, the sectors that are interesting are financials, real estate. And I would add in healthcare down the cap spectrum. It's less interesting on a large cap basis to me from a risk reward perspective. And it more acts like beta from a smaller cap perspective. It's more cyclical. But to your point, you do have deeply unprofitable companies as you go down the cap spectrum. In some ways, what you've seen in a lot of ways has been a defensive or quality rotation into buying the S&P 500 or even the Qs relative to anything else because they have earnings. The one thing that has been very true, especially in the small cap index or IWM, is that every cycle that we've had has had a lower proportion of those companies actually generating any profits. Now, that's not true in the mid-cap space. So if you are interested in going down the cap spectrum to get that relative valuation discount that I'm talking about, but without all of that earnings risk for those deeply unprofitable companies that may never make money, right? We don't know the answer. I think the mid-cap space is a really positive risk reward as well.
So you've mentioned a number of times the top sectors that ultimately could do well in this environment of cutting rates. What about the bottom?
Yeah, bottom is still defense.
Okay.
So I would put
traditional defense. Yeah.
You got it. So, what do you worry about? If you're worried about a recession, you go out and you buy your toothpaste, you go to the doctor, you pay your utility bill. That's why staples, healthcare, and utilities tend to work really well when the economy is either in rough shape or heading into a recession. And I think that I don't want to say it's off the table because it's never off the table, but the risk reward behind that, I think, is still negative. You also have a situation specifically in healthcare and specifically in staples where the margin pressure is deeply different than what we have seen historically. Yeah. One of the really nice things about having historical data is you can see what's similar, but you can also see what's different. So I could show you data that says, well, if earnings is going to accelerate and the Federal Reserve is cutting, maybe healthcare does well. But what is very different about healthcare this time is that at the sector level, EBIT margins have never declined as they've declined over the last 18 months, and they've never been in a secular downtrend over the course of the last 15 years. So when we compare things historically to, say, the 70s and 80s, which a lot of people lean on because that's when we had higher inflation, in terms of parallels, you don't find the same fundamental situation we're in, where healthcare during that time period of 70s and 80s, and really even into the 90s, was both offense and defense because margins went up regardless of if the economy struggled or didn't, and regardless of if the stock market went up or down. That now sounds a whole lot like technology.
Yes, it does.
Which can be both offense and defense. Okay. Right.
And you would sometimes attach the term evergreen because for all those same reasons. The disruption within healthcare, or even the potential disruption, everything from the weight loss drugs that seem to be, potentially will have effects in other parts of the healthcare sector, as well as AI being discussed as an area that it can be put to good use in healthcare. How much of the healthcare story is the disruption piece, and how much of it is, fundamentals because of where interest rates are and used to be?
Yeah, and I think maybe healthcare demand and pricing power at the aggregate level, right? So I think in some ways, when I think about productivity and the uniqueness behind the GLPs, I think that those are unique situations. They're idiosyncratic. Whether or not that they can forestall a trend that is price compression that we have seen over the last 15 years, I think remains to be seen. So it doesn't necessarily mean that the entire space is uninvestable. You can pick your spots where there is productivity gains or where there is actual sort of creation of new revenue and new margins associated with that. But for the entire sector, I think that there is a wall of a lack of pricing power in aggregate that is not that different from what we're seeing in consumer staples. There is just not the same pricing power that these sectors have had historically. And it's partly because the share of wallet now for the US consumers is high enough that it's almost like in aggregate, again, this is not specifically in any one industry, it has to be X growth. There's only so much you can spend of your own money on the next drug.
Take us to the demand picture, and this might be across a number of different sectors, because we've been talking about actually supply within the labor story and the demand within the labor story. I wonder if we can kind of come back to that and where that lands. The supply story is the bigger story right now, but where is demand, would you say, if we come back to labor?
The supply story is why we're seeing something that we're seeing, which is an increasing unemployment rate while we're seeing positive non-farm payroll growth. But the demand story, it's funny because I think that the data can support many conclusions. A lot of people point to demand and say, hey, on a nominal basis, we're still growing too fast and the Federal Reserve should be hiking. And some people are saying demand is intrinsically weak and it's negative on a real basis. The way I look at the data is it's meh. Like, as my kids would say, right. It's just middling. It's mid, right? I mean, there's really, I would say, we shrank very quickly in COVID, then we grew very quickly coming out of COVID. And now this renormalization, whether you look at real retail sales, real consumption, real investment spending, even ISM, right? You sort of go, they're all mid. They're all just mid. So it's not growing too fast. But it's also not really showing signs of deep distress either. It's almost just this period that is becoming sort of, potentially a longer lived period of middling growth. That doesn't predict one thing one way or the other. It doesn't predict an acceleration and it doesn't predict a deceleration. So I don't really view it as we're not so strong that the Fed's got a problem, but we're not so weak that the Fed has a problem either.
And so what does it do? You've mentioned margins. You were talking about that. We're about to enter earnings, so maybe I'll just get a couple of comments on earnings specific to sort of the labor story, but really the wages and the margin story. So if you've got demand that's meh and you've got more supply, presumably that can bring wages down.
Yes.
What's that do for earnings?
Yes, it's interesting. So your point, my economy is mid. So Denise, doesn't that mean you don't want to own stocks because the economy is mid? That's what the economy, don't confuse it. What the economy does is not the same thing as how profitable corporations are. And that is the difference this cycle. And I think people lost the difference this cycle. And it was around inflation, and the nuances around the deceleration of inflation usually means that profit margins can expand. And that's exactly what we've seen. So whilst the CPI is still decelerating, we are seeing a disinflationary trend, goods costs or input costs for corporate America are decelerating faster. And you can measure it in a bunch of different proxies, a bunch of different ways. I like to use the CPI minus the PPI, and you'll see we're still pinned at top decile levels for the fifth quarter in a row. And if you look at that historically, what does that usually mean over the course of the next 12 months? And it usually means operating margins continue to expand. If operating margins continue to expand, profit, as we talked about last time I was on the show, profits usually continue to support growing payrolls. And if payrolls continue to grow, then that means that the economy is likely still in, a positive business cycle, which likely supports the bull market.
So interesting thoughts on rotation within, the reasons for it, potentially a bull market, but as you say, maybe with a cut, and therefore interest rate sensitive stocks may float to the top in terms of your list. What does it mean in terms of, I guess, from the asset allocation perspective? Equities are still, you tell us good things about equities, so I think you're going to say equities are still the place to be. But I still want to ask the question: is it still U.S. equities the place to be above all other asset classes, basically?
I do, and it's true. I am bullish on U.S. equities. But when I look at what happens typically in interest rate cuts environment, it's going to be tough for bonds to keep up. It's going to be tough for commodities to keep up when earnings growth is still growing. So to the extent that you thought that earnings growth was going to decelerate or potentially recontract, I think that might set up a different situation for the asset allocators. But in the situation where earnings growth is positive and the Federal Reserve is cutting, I think that equities are leadership from an asset allocation perspective.
And equities in the U.S., and this goes to sort of the currency and the dispersion on interest rates around the world, I guess.
Exactly. I think that U.S. exceptionalism, as it's called, is still the base case. And it's partly, it's not just around the interest rate differentials, because you'll probably see a little bit of currency give back to the extent that the Federal Reserve does cut. But I think it's the growth differential that is likely to be sustained and even at some point renewed from the rate cuts that we're seeing relative to Europe and relative to emerging markets.
So eventually the rate, the growth rate ultimately renewed. Is that after, I mean, you do hear people talking about there could be some version of a pullback. We are at some heady levels in certain stocks. There's rotation potentially there. But it does sound like there is some cash on the sidelines waiting for better prices, essentially, to enter. Is that about right?
Yes. Yes, and I think that that's usually a good indicator of the wall of worry, right? Because if you're waiting for that correction, by the way, we've seen one year to date, right? The Q's actually corrected almost 8%, not quite, but you did see it. The question is, can you get that money to work as quickly as you need to actually execute on that from a risk-reward perspective? It's very, very difficult. And so to the extent that you see a lot of investors on the sidelines waiting for the correction, you usually don't get them to be either very steep or very durable. So you might get them very quick, and you can wait for that if you want. And if you're itchy on that trigger finger, you might get it. But it's probably not going to be durable enough that you will have looked back and said, wow, I nailed both the peak in terms of selling and the trough in terms of buying, and I made money on that trade. That's why, for me, I just look over the next year. Do I think you want to own equities? The answer to that, to me, when I look at the data, I say yes. And 60% of the years since 1962, you're going to see a correction between 5 and 15%. I think you want to be buying that.
And so you're not going to tell us that it should be now before the recession hits, because it'll be too hard to get in once it already does, or if there's like a little pullback. But I'm going to suggest that that's probably underneath what you're saying. So there's an idea that, if you don't want to try and time whatever pullback may or may not happen, now looks good.
Right. What's the quote? So, don't time the market, try and stay time in the market.
Right. Okay. We'll leave it on that. Denise Chisholm, a pleasure to speak with you as always. Thank you so much for joining us. Have a great rest of your day.
Great to be here, Pamela. Thank you so much.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. And while visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.